Welcome back. I'm Pierre Daly, managing editor at advisoranalyst.com, and this is Insight is Capital. My very special guest this episode is Ilan Kolet, portfolio manager at Fidelity Investments. Ilan is a prominent figure in the investment industry, renowned for his role as an institutional portfolio manager in the Asset Allocation Team at Fidelity Investments, where he works closely with David Wolf and David Tulk. His extensive background in financial analysis and investment strategy has equipped him with a deep understanding of market dynamics. Ilan adeptly interprets economic trends and is well known for crafting effective investment strategies, distinguishing him in his field. In addition to his portfolio management role, Ilan is also known for his contributions to the financial zeitgeist. He provides valuable insights on market trends and economic forecasts, demonstrating an ability to clearly articulate complex financial concepts. He is a valuable resource to both the institutions he serves and the broader investment community. His blend of academic knowledge and practical experience in finance cements his reputation as a respected figure in portfolio management.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Ilan, welcome. It is an honor to have you on the show.
Thanks very much, Pierre. I'm excited to have this conversation.
Likewise. Ilan, for those of us who don't know you, tell us a little bit about your career, how you got started in the industry, and what you're working on these days.
Sure. Yeah. So, let me rewind a little bit to, maybe graduate school. I went to graduate school for economics at Simon Fraser University out in BC. And then immediately after graduate school, I went to the Bank of Canada. I went to the Bank of Canada, I guess in 2002, over 20 years ago, where really that provided the basis and foundation for, I think, everything else that followed. And so the Bank of Canada was a wonderful place to work. It's the finishing school for economics students, I think. And I worked on the U.S. economy as well as commodity prices. I worked under David Dodge and Governor Mark Carney.
Amazing.
After my time at the Bank of Canada, which was around just over 8 years, I moved to the other end of Spark Street in Ottawa, and I joined Bloomberg News. And this was an interesting role. This was a role where I had an exceptionally long leash. My job was to be an expert in terms of data, but also think about data and the story and uncover stories and ideas with my colleagues in Ottawa, in Washington, and New York. Really the perfect intersection of sort of nerd and creative. And then in 2014, my former colleague, David Wolf, who I worked and knew from my time at the Bank of Canada, gave me a call and mentioned that there was a really interesting opportunity on the Asset Allocation Research Team in Boston. And 3 months later, I was living in Boston, and shortly after my family followed. And I lived in Boston 2014 to the middle of 21. And I ended my time on the Asset Allocation Research Team as the head of inflation and commodities research. It was a pretty good time to be covering inflation. I joke sometimes, Pierre, that the hardest thing about that role was making a number that hadn't moved in 25 years interesting every month. And then that number moved from 2 to 9 or 2 to 8. And then in the middle of 21, we moved back to Canada. I moved to Toronto, and I joined the Canadian Asset Allocation Team, managing the multi-asset class funds for Canadian investors. And that's where I am now and have been for almost 3 years.
Amazing. I mean, what an interesting and varied career. And Boston, what a great city to live in for as long as you did. That's quite an addition to your experience as well, I'm sure.
Yeah, it was a wonderful experience. I mean, we still work very, very closely with the research teams that support us out of Boston. Again, I was on that asset allocation research team. And the unique thing with that team is, well, first, I don't think a lot of firms have that type of dedicated asset allocation research. And I was assessed when I was a researcher on whether or not the decisions and the research that I was producing was additive to the portfolios and the portfolio managers that I was supporting, right? So there's a very clear, there was no interference basically between the research brain and the portfolio management brain, which is an outright edge. I joke that I'm a recovering research nerd. I don't think there's any substitute for great research, and it's a major part of our process.
So, Ilan, before we get into the nuts and bolts of our conversation, I'm just curious to know, with the times that we're in, it's a lot of uncertainty. There's a lot of, there's a lot of movement and gyration in the market. We've got a flattening yield curve sitting in the U.S. at least around 5, and I think in Canada around 3.5 to 4. What are you optimistic about these days after the year that we've had for the bond market, where we've got rising short-term rates and also rising long-term rates, which have been sort of a double whammy. The rising short-term rates have provided a measure of relief for investors looking for not only a safe harbor but a place where you can get some yield. But on the long side, on the long duration end, it's been a nightmare. And the funny thing is that if you look at the flows into long-term treasuries, they've been, insatiable for this year. So anyway, what are you optimistic about?
Sure. Yeah. There's a few different ways we can take that question. Sometimes
sorry, I've sorry to interrupt you, Ilana. The equity market, we've had the Magnificent Seven, enormous 8 equity market. There's a lot of dispersion in the equity market now as well. We've got really sort of this grand bifurcation in the market that's left people feeling a little bit, nervous and uncertain about where things go next and what happens next to the economy. So, sorry, let me just to preface our conversation a little bit, but go ahead.
Yeah, so I think there's a few different ways into this discussion, and maybe I'll rewind slightly and just explain sort of what we do and how we do it, and then that will explain the different ways we have of winning and where we would be optimistic. So our job, myself, David, and David, our job is to reach across Fidelity, both in Canada, in the US, and internationally, and pick managers, right? No managers are forced upon us. Pick underlying fund managers that we believe are, the best players for our team. And then assemble them in such a way to create very balanced exposures across these funds of funds that we're managing. And all of those underlying managers are incentivized to beat their own benchmark, right? So if they win against their benchmark, we win by owning them.
Right.
And they're incentivized to turn over more rocks to find those winners, even in a very difficult cyclical environment, right? So even, for example, with our emerging markets manager, if the cyclical isn't looking great in emerging markets, he still has a very strong research team and a research process and an investment process where he will be able to beat his underlying benchmark. And again, if we own him, we win as well. The second step to what we do, and I promise I'll actually answer your real question in a second. But the second thing that we try to do is we use our 4-pillar research process to lean in or out of asset classes, currencies, geographies, styles. And that's us thinking about the relative outperformance or underperformance of, say, Canada versus the US, or commodity producers versus overseas equities. And again, those are our 2 ways to win, right? And over time, those 2 things will not necessarily win together every day or month or even perhaps every year. But over time, combining those 2 pillars has proven to be very, very effective in generating excess return above our benchmark, or, for example, a 60-40. Now, Pierre, to answer your question, what are we optimistic about? Not Canada, so we should talk about that.
Sure.
But I think there's a diversity of views on our research team and even amongst us, but I'm quite optimistic about the US. So let me start there. I think the likelihood of a soft landing has materially increased in the last 6 to 9 months. And I think that's because of a few things. The first is the U.S. is just less interest rate sensitive, probably than it's ever been, for a number of reasons. Debt levels, household debt levels, are not as extreme as they are in Canada. I mean, Americans had a major systemic financial crisis in 2008, right? Nearly 10 million Americans lost their job. They took the medicine and delevered meaningfully, and some by force, and it was exceptionally painful.
Right.
They didn't re-lever when rates declined, unlike Canada. But the other thing to think about, the two other things I think that are worth hitting on is the structure of the mortgage market is very different in the U.S. So again, I lived in Boston. I just lived south of Boston from 2014 to the middle of 21. I had a 30-year fixed rate mortgage that was 2%. I only lost that because I moved. I mean, we'll see how that trade works out. But I only lost that 2% fixed rate mortgage because I moved. And every single neighbor on my street refinanced pre-COVID. And I knew this because, after dinner, I'd walk the dog. And over a 9-12 month period, every neighbor would ask me, they knew I was an economist. Is now the right time to refinance my mortgage? And I would pull out my phone and show them the chart and say, like, how much lower do you want this to be? Right. So a huge portion of American homeowners refinanced pre-COVID. And so they're just staying put. And businesses did the same thing, right? So businesses turned out their debt, which is in English, refinancing the debt to take advantage of those exceptionally low rates. And so the corporate and the household sector are just less interest rate sensitive than they've ever been. Now, the caveat here, the footnote is, it would be very unprecedented to have 525 basis points of tightening by the Fed and not have a hard landing. But the statistics and metrics that I look at, it really looks like the likelihood of a soft landing has meaningfully increased. And then the last point to make there is, this is something we were discussing, of course, before the call, is we think that it's not impossible that the potential growth rate of the U.S. economy is higher than what we're observing or what we think it might be. And what that means is perhaps because of advancements in artificial intelligence, investments in clean technology, more flexible work arrangements so that you're optimizing your life a little bit better. Maybe that has boosted the potential growth rate of the U.S. economy. If that's the case, that's an exceptionally positive outlook for U.S. growth, U.S. earnings, U.S. companies. And it has happened in the past, right? So in the mid to late 90s, with the advent of the internet, and the internet really dramatically changing business processes for many firms, the stall speed or the potential growth rate of the U.S. economy was higher than what we thought it was. In that period, the recession models that we were using, which honestly they're pretty similar to the ones we're using today, were flashing red signals about the increasing likelihood of a recession, and we never got it because of that boost to potential growth, because of a dramatic change to really business processes and investment.
Yeah, that's a very interesting view. I think the subject of the mortgages is one that seems to be coming up quite a bit. U.S. mortgages are also tax deductible, are they not?
Yes, right? They are. Yeah, and I mean, I didn't know this when I didn't know this when we first moved to the U.S. Yeah. I moved from Ottawa down to Boston in 2014. I didn't realize they were taxed. The interest on your mortgage is tax deductible, and my gosh, that was a pretty nice surprise to get.
Sure, I mean, I've always made those. Yeah, I mean, over time, when I've been back and forth to the States, I've always maintained that American consumers have far more disposable income than Canadians, and that's actually, I think, one of the reasons is that each and every year you're getting a substantial tax reduction just from owning a home. And
yeah, it is. I mean, it's a bit strange because it's a substantial perk. There's no question there. It incentivizes home ownership. It also incentivizes not paying off your principal mortgage in full, right? Because So there are some odd incentives there. It's definitely a perk and an incentive for homeowners. Homeowners tend to be at the higher end of the income spectrum, right? So it has been viewed as sort of punishing. It's punishing for renters and a perk for homeowners.
Right.
And so there's quite a bit of research around that. But no, I think, Pierre, to your point, there are very few things as powerful as the U.S. consumer, right? It is an exceptionally powerful force. And it can basically fuel the global business cycle, the U.S. consumer alone. I don't have the stats handy, but just the U.S. consumer, I think, is something like the third or fourth largest economy in the world. Just the consumer part, right?
Yeah.
So it's a very, very powerful force. And if I look at the state of consumers right now, I mean, you really have to squint to see any sort of cracks. Again, as long as, and this is in fact even the case in Canada, perhaps less so.
I think to your other point, I think the fact that most U.S. companies refunded their credit during the time when the sun was shining at 0% policy rates is also something that might be underestimated as well. I mean, I can see you can see when you look at the the modeling where the lags that people talk about, that economists talk about, the long and variable lags are much longer for the U.S. than for Canada. And you mentioned that you're more optimistic for the U.S. than you are for Canada, but that certainly is a factor, isn't it?
Absolutely. I mean,
yeah.
That difference in interest rate sensitivity, I think, in our view, is the reason why we're underweight Canadian equities and overweight U.S. equities. Now, we're very neutral beta in our 60-40, for example. We're basically sitting on top of 60 and 40, but there are opportunities and areas of defensiveness within the portfolios where we're underweight and overweight. And so, to your point, Pierre, that interest rate sensitivity is critical to that thesis. I mean, the U.S. is exceptionally resilient as well. I mean, the U.S. has a much more flexible labor market than Canada, and that means that in periods of stress, that line down in terms of job loss is a straight line down, and I mean that again that contributes to front loading the adjustment. This is something you saw in 2008. When the job loss came, it came exceptionally rapidly. And also U.S. labor is more mobile in the U.S., right? So it's not uncommon, for example, for my brother-in-law who worked in New Jersey to pick up his family and take a job in Indiana. That type of labor mobility is much more common, I think, in the U.S., and that contributes to the resilience of the labor market and the economy. It's less so in Canada. In Canada, I think the joke is most people kind of buy a home and within 5 kilometers of where their parents lived or something like that. But back to the interest rate sensitivity discussion. I mean, this is of what's significant concern to us in Canada. Happy to dig into that, but for that we need to rewind. We do need to rewind to 2008 because Canada had a very different experience through 2008, and then when rates declined, we went gangbusters. We went way over our skis on household debt, and that's problematic with 475 basis points of tightening by the Bank of Canada.
Yeah. So my next question is, what are you pessimistic about? I know you've we've sort of covered some of that. I mean, it sort of goes hand in hand with what are you optimistic about? But what are some of the highlights or key points of pessimism in your models?
Sure. Yeah. I mean, perhaps these are lowlights instead of highlights. But again, we have continued concern around the macroeconomic stability and sustainability in Canada. And for that, I think the best thing to do is, again, to rewind to 2008, right? So if we rewind to 2008, systemic financial crisis, 1 in 100-year type of event in the U.S., major deleveraging moment, millions of job lost, of jobs lost. And in Canada, I mean, Canada sort of comes through the financial crisis first or second best in the G7, sort of depending on how you measure it. I was at the bank at the time, and under Governor Carney, we had 5 well-capitalized banks. We didn't have the dodgy mortgages that the U.S. had. We had China growing at, 10 or 15% and buying all the commodities we could export, right? So there were a few contributing factors to that resilience, but then rates moved much lower globally, including in Canada. And then post 08, Canadians did what low rates incentivize you to do, right? So they bought the houses, cottages, condos, sea-doos, ski-doos.
Right.
In Alberta, they'll mention quads. I don't know what those were. They're like 4-wheelie things. So you buy these
like ATV.
ATVs, right.
Yeah.
So you buy these large durable assets that you can finance at a low rate for a long time. And servicing that debt is fine and manageable unless you get the largest inflation shock in 40 years, resulting in 475 basis points of tightening by the central bank. And that's exactly what we got. And so our view for a long time has been extremely elevated rates of household debt by really any measure or comparison across countries, intersecting that much tighter monetary policy and higher rates is going to show up in consumer spending, discretionary consumer spending, inventories, business formation, and will eventually lead to a meaningful change in economic growth. Now, what I mean by that, like how we get from high rates of debt and higher borrowing rates to a recession or a pullback is, Canadians have full recourse mortgages. We don't really have a culture of giving back the keys.
Right.
But in my view,
we don't get the benefit of tax deductions for our interest.
No, exactly. Right. Which would be incredible, but no, we don't have that. So what would normally happen, I think the way this plays out is, again, the housing market in Canada was on fire 2019, 20, and 21. If most of us have 5-year terms on these, and you add 5 years to 19, 20, and 21, you have 23, 24, and 25.
Right. So the refunding of mortgages is coming up. Yeah.
Exactly. Right. So there's this really stressful stress test coming up for a lot of people renewing. It's already happened to the folks with variable rate mortgages, but for the standard mortgage, this hurdle is coming up very soon. And again, I think the way it plays out is because most Canadians will do whatever they possibly can to make that principal mortgage payment, they'll cut discretionary consumer spending, right? So consumer spending is 2/3 of Canadian GDP. Discretionary isn't all of that, but you get, again, if the amount you need to pay on your mortgage or the debt service payment every month increases, you swap out of the steakhouse into ordering pizza, right? Or the kids go to 1 week fewer summer camps. That sounds terrible, but make these discretionary consumer spending changes that results in a pullback in consumer spending. That means those summer camps and those steakhouses perhaps need fewer workers, or the workers that are there don't ask for such strong wage increases. That leads to a pullback in demand, and ultimately a pullback in wage growth and a pullback in core inflation, which we can get to, but that's the ultimate goal. So, my colleague David Wolf has said a recession in Canada, and this type of these linkages that I just described, they're a feature, not a bug, right? This is exactly, some pain is an intended consequence of elevated rates to cool demand. So again, we have, the Canadian economy has been remarkably resilient. And we think there are a few factors that have helped with that resilience, which we can talk about. But again, growth since the start of this year has been a flat line, right? So the Canadian economy has not grown since the start of this year. It's not impossible that next year, like the statistical agencies tell us, oh, by the way, last year you were in a mild recession, right? So again, it's a lot of the times when you're dating recessions, you're forecasting the past. And my experience is it's a lot easier to forecast the past than the future.
Yeah. And Ilan, what about the third of the Canadian economy that's not consumer driven?
So Well, there are different elements there. I mean, the most
Yeah.
rate sensitive part of any economy is the housing market, right? And so the housing market is, and there's a great paper written in 2007 by Professor Ed Leamer, called Housing is the Business Cycle. It's a little bit nerdy. The back half of it is a little bit nerdy, but the first chunk is really digestible and readable. So that's, I would suggest people check it out. And the reason he puts forth this thesis that housing is the business cycle is it is the most rate sensitive part of an economy, right? So when rates were increasing tremendously in that 18-month period, when rates increased 475 basis points in Canada, 525 basis points in the US, housing came to a standstill. Housing activity just came to a crawl. And while there's been some sort of signs of life in housing now, again, it's a much higher hurdle for most borrowers. Similarly, in a recession, when rates decline, the first thing that sort of comes back to life is housing. The other parts of that add up that aren't consumer spending are things like are important line items to look at as well. Things like business investment, right? So business investment is what what a lot of us think of as CapEx. It can be building and plants and structures. It can be software, and it can be intellectual property. So it's bucketed that way. And then there's government spending, and there's also trade, right? So there's exports and imports. This is the classic GDP add up. But honestly, with 2/3 of the Canadian economy being consumer spending, slightly higher in the US, that is the most important driver of I would say a recession or a recovery, right? As soon as you get as soon as you get a consumer pullback, a meaningful consumer pullback, that basically is a decline in growth. Very hard to avoid because those other chunks just can't compensate enough to offset the pullback, and they're very linked as well.
So, Ilan, how are you connecting your economic outlook for Canada, where we possibly find ourselves in a deeper recession than let's say, or deeper slowdown than the U.S. over the next couple of years? How does that translate into what you're doing on the investment side?
So,
specifically for Canada.
There's a few ways for us to think about that. We really firmly believe in the division of labor when it comes to the management of our funds. So while I just set up the case for an underperformance of Canada versus the US, and that explains us being slightly...
Well, that's the macro, right? I mean, we're talking, that's the macroeconomic performance.
Right. So that's exactly. So that's, and that would flow into, we think, equities as well, right? So, and that explains why we would be perhaps underweight Canadian equities and overweight US equities. I mean, we still have those underlying managers that we're using in our fund of funds that we definitely want them to beat their benchmarks, even if we're slightly underweight Canada. I mean, and again, so in our 60-40, roughly 21% of the equity side is Canada. It's Canadian equities. We just shave, 4 or 5% off of that because of that relative outperformance we expect in other regions. But there's still a sizable chunk of that 60-40 that is made up of Canadian equities and associated Canadian equity managers that we're using in our funds. So again, those managers are still incentivized to use their investment process and their research to find the companies, even if Canada is in a stressful macroeconomic environment, choose this bank instead of this one, or choose this energy company instead of this one, to relatively outperform, right? And do well against their individual benchmark. Again, what I would say is the reason I mentioned that division of labor, Pierre, is we talk to our underlying managers very often. We read the research that is informing their investment process, but we would never dictate or even try to dictate to them, we're worried about Canada, you should avoid this and buy this. I mean, there's a full division of labor here. They'll fall. We want them to do what they're best at, and then we can own their funds.
Right. So, I mean, in your asset allocation process, you're allocating or you're either allocating or not, or you're cutting back your allocations or increasing your allocations. You're not dictating to any particular portfolio manager's mandate about what to do. But obviously, you're getting a lot of feedback and conversation between you and them that's informing your decisions.
Exactly.
They tell you what they think. You tell them what you think. You tell them what you're doing, whether you're going to increase your allocations or cut your allocations, depending on your model, your outlook. One of the best things I've heard lately is that this is a market where you have to. You're not making binary decisions. I mean, in your work, you're not making binary decisions in the asset allocation research team. You're deciding how much to weight, what the probabilities are of different outcomes, and deciding who and where and what gets what allocation across the board. But you're not cutting anything out completely,
No.
because frankly, I mean, the markets are unpredictable. Things can change, and it's not a matter of an on-off switch or invest, don't invest. It's always a matter of probability and calibration, right? I mean, deciding how much and where to invest. So your asset allocation outlook, your strategic mix, tactical mix is cutting back on Canada, not cutting out Canada.
Exactly.
Yeah.
And here, that's a very, very important point that we can't stress enough, right? So, our industry, I think sometimes we have this terrible term, back up the truck, right? When asset classes are cheap, back up the truck. I mean,
right.
Anyone who works with a good quant team that examines risk metrics will never, ever say that line. And it's because, the way that we're managing these funds is a really strong research input, 4 pillars, which are macro, sentiment, valuation, and bottom up. And then the size of the overweights and the underweights will be reflective of the conviction that we have in those views, right? And so not every view we have is a table pounding high conviction view. And that will be reflected in how much we're leaning in or out. So again, when I started on the team, a mentor mentioned to me that what we're trying to do is add 1 basis point to the mountain, 1 basis point at a time, right? So This is not a back up the truck type of environment. And it's important. I mean, those underlying conversations that we're having with our fund managers, that bottom up pillar, to me, that has become an absolutely critical part of our process. So, for example, we had a very strong view on the macro in Canada. Elevated rates, 475 basis points of tightening on top of incredibly indebted households is going to be really stressful. But, one of the reasons that underweight on Canadian equities was not as large was because of some of the conversations we had with the underlying managers and their researchers speaking about the resilience in Canada, right? So, the accumulated savings of households was a contributing factor. Creative mortgage math from some of the mortgage lenders was a factor. 1.5 million people moving to Canada. Population growth of 1.5 million. 500,000 people moving to Canada last year. That's a major factor. So there were these factors that caused us to not lean in as negatively as we could have, because while the macro looked very troubling, again, the bottom up pillar that's looking at the earnings reports and speaking to the underlying researchers and managers was not as troubling as the macro would have suggested, right? And so that's a very, very important part of our process, and it's peppered throughout the portfolio in overweights and underweights.
Right. And you're picking managers. You're also picking between styles and factors. Growth versus value. You're picking or momentum. Depending on where alpha's coming from. But you have a base. You have a base model that you work with, and then as you said, you're looking to add incremental amounts of return through your weighting process to that base model.
Yeah, that's right. And then I think in terms of we really don't want to ever have a bias, right? So we don't want a style bias. We don't want to be only growth or only value. We never want to have a country bias, right? So in my head, the plot of diversification is not just geographies and asset classes. It's geographies, asset classes, styles, manager styles. So, and the reason for that is if we combine, in our view, and according to our research, if we combine managers of different styles, right? So we combine that US large cap growth manager with the overseas European value bank manager. If we combine them in such a way, the end ride for the end investor is smoother, right? And so we're not getting whipsawed by the style that might be in favor that month, week, or year. And similarly, for the geography part, I mean, I think it's very common, I think, for Canadian investors to have home bias. It's very natural, right? So you want to invest in the company that you drive by on the highway on your way to work. I mean, back when we used to come into work, but, or, you want to invest in that company that someone who works for. But too much style bias, too much geography bias, right? Too much home country bias would have left a tremendous amount of return on the table, right? Had you only been invested in like Canadian companies, for example, you would have left an enormous amount of return on the table over the last 15 years, right? So we never want to have these biases.
That's a big problem in Canada. I mean, that's a big problem in almost every country is country bias, in a portfolio. And, we, like you said, we like, when we're driving, we like to see the billboards and the signs of the companies we like and love, right? I mean, that just gives us an element of comfort as investors. But there's a whole world of investment out there, and one of the biggest problems that we have is this home country bias issue that arises in practically every portfolio, across the country. Is having weighing between familiarity and opportunity is a rather big concern. But I think for advisors, where I see the benefit of what you do is that advisors have this constant problem of line item risk in their portfolios. So when they want to diversify properly, when they want to take their clients' assets and divide and not only discuss with them diversification, but actually act on it, that leads to a whole range of problems for the advisor and for the client as well, which is this lack of willingness in many cases to commit to a diversifier or commit to a diversification. That's probably, we talk about it every day. Oh yeah, the best insurance for a portfolio is diversification. It's free lunch, all the different adages and idioms people have for diversification. The reason that all those adages and idioms exist is because diversification is the hardest thing to accomplish. We can all do it for ourselves. I can personally diversify my portfolio, but if I'm responsible for, 300-400 clients and I want to diversify them, I have to have that conversation with practically every single one of them and then help them to understand, why do we have this energy stock, or why do we have these commodities, or why do we have these alternatives, or why do we have, look, they're not doing anything for the portfolio. Look, my Magnificent Seven, that's what's driving everything right now, right? Or that's what's driven everything this year. Why can't we buy more of what's winning? And that's that recency bias where people are looking at their portfolios and they're saying, well, why do we own all this other stuff? And you have to constantly remind. And that's where what you do takes the heat off the advisory question, right? Which is, how do I overcome the line item, the line item problem that I have every quarter or every year when I do reviews? And if it's wrapped up in the one line item where you're doing it all and it's not immediately visible in their statement, then that's actually a very big problem solver.
Well, exactly. I mean, so yeah. Pierre, sometimes I've described the portfolios we're managing, these multi-asset class funds, as really elegant solutions to really complex problems, right? And so what I mean by that is, in the span of an hour, I can have a conversation about this cyclical risk in China, AI opportunities in the US, household debt concerns in Canada, How are we protecting the funds against inflation? Why are we underweight the Canadian dollar, right? So a huge range of topics. All of those are being fed by researchers that we're working with, and that's feeding the positions, or that's informing the positions that we have in our portfolio. So again, it's a very, very a complex optimization problem that is sort of made simple or simpler for the end investor in these fund of funds by again diversifying across managers, across styles, across geographies, and then also our ability to take out of benchmark overweights or underweights as well, right? So, that's particularly important in the case of, say, inflation protection, right? Which I'm a long-standing inflation nerd, and that was a major high conviction view that we had for some time, and because of that, we built that insurance into the portfolio. And in fact, we even launched a dedicated multi-asset class investment inflation protection fund in September of 21 as well.
So, Ilan, speaking of inflation and inflation protection, why don't we maybe talk about your view on inflation and its potential impact on portfolios, and then how do you build in inflation protection into your asset allocation?
Sure.
That's three questions.
No, but those are the three most important ones. I mean, I think there's the three questions are: where is inflation right now? What's happening with inflation?
Right.
The second one is really why should we care? Yeah. Like what's the damage? Why should we care?
Yeah.
And then the third one is what are we doing what have we done and what are we continuing to do to protect investors against the damaging effects of inflation? So, we sort of know where we are now. I think inflation went to 8 and 9% in Canada and the US, right? These were higher inflation rates than like Mexico and India. I never thought I would say those lines in my life. Inflation was driven higher by meaningful supply chain disruption, sort of a wartime supply chain shock, and all of us being locked into our houses, and we were only able to consume and buy the Pelotons and the air fryers, and we couldn't buy anything else. And I bought both of those things, and I'm not using either now.
Interesting.
So we
same here, by the way.
Right, exactly. So lots of us competed for fewer goods, and that drove the price higher. That shock has rolled off, right? So goods prices are now inflating or growing at the rate that they were pre-COVID. Now, to be really clear here, Pierre, nothing is going for sale. There was a price level shock, right? So what I mean by those things are growing, the inflation rate for goods is now roughly now the pre-COVID inflation rate. But there's been a meaningful step higher in inflation over the last 3 years. Actually, I pulled a couple stats. So over the last 3 years, food prices in Canada are up 23%. Eating out at restaurants is up 18%. Shelter is up 19%. Vehicle prices are up 18%. And wages are up 13%, right? So think 20 versus 13. And that's why everything feels a lot more expensive, because it is when compared to wages. What we're left with now on inflation is the stubbornly sticky part, which is services. So services are 3/4 of the underlying inflation pie. Services are determined by the price you pay the person doing the service, right? So when you go to the mechanic, it's not the part that's expensive, it's the person's time, right? When you go to the steakhouse, the reason that steak is expensive is certainly inputs, but also the person's time at that restaurant. And people are much more expensive now because the labor market is exceptionally tight. So we've had a view for a long time that 8 to 4 would be pretty easy and mechanical. 4 back down to 2 is going to be sort of slow and crunchy and require some pain. Now, why should we care about inflation? Well, I think I used to say the 70s provides a great example, but 2022 was an excellent example as well, right? So again, I'm sorry to rewind to these awful years for us, but the problem with inflation is it erodes the negative correlation between stocks and bonds that we all know and love, right? So, so that founding principle where stocks give you the upside in periods of growth and bonds give you the protection in periods of stress, that inverse relationship comes under pressure with elevated inflation and elevated inflation volatility. The 1970s is a great example of this, right? So if you were sitting in a 60-40 in the 70s, I mean, unless you owned the land that produced the commodities, because commodities were fairly uninvestable, it was a lost decade. And 2022, I mean, again, from an absolute return perspective, you have to own cash, you have to own the US dollar, and you have to own commodities, right? If you didn't, I mean, bonds and stocks were sort of down and downer. And so how did we, in relative terms, to preserve basis points, what we did last year and what we sort of continue to do is we have a sizable underweight to the Canadian dollar, most of which is an overweight to the US dollar. We have higher in our 60-40, for example, well, really across the funds, we have a slightly higher allocation to cash than we normally would. Now, for people on the call, I mean, investors hire us or buy our funds to be fully invested, not really to hold cash. And last year we had 8 or 9%. Like last year, 8 or 9% of our fund of our 60-40 was held in cash. And then the third point is we own commodity producers, right? Oil and gold. And on the inflation protection side, on the bond side, we own tips, right? So we really have built in elements of inflation protection. Most notably, I think the commodity position, which was elevated, quite elevated last year, and has been reduced this year because of the improvement in the inflation data. But we just don't think, I mean, to put a bow on it, we don't believe the war has been won yet on inflation. Again, this ties into rates, but we have not seen, especially in Canada, we have not seen that labor market adjustment that we think we need to see in order for wage inflation to slow, service inflation to slow, and core inflation to slow. And so anytime you hear a central banker like Governor Macklem or Chair Powell talk about adjustments in the labor market, immediately you should think wages and service inflation, because that's the linkage that they're thinking of as well.
Well, and look at what's happening. You know, look at what's happened. Like, for example, one of the high profile strikes has been the Hollywood strike. And, you know, it only just got resolved, and it resulted in some substantial raises for, you know, the writers and actors, and royalties are substantially, you know, got negotiated substantially higher, more favorable for basically all the key workers in the industry.
Exactly. Right? I mean, it's the same, you know, the UAW negotiation.
And the auto, there was the big auto settlement. I mean, 25%. You know, those are very big. Those are very big labor settlements that have yet to.
They are.
You know, yet to.
That's right. Maybe after this call, I'll ask my boss for a 25% raise and see how that goes. Yeah. I mean, but again, you know, Pierre, when I hear UAW asking for 40% over 4 years and a reduction in the work week from 40 hours to 32 hours, immediately in my head, that's a labor market anecdote. That means the demand for F-150s coming out of that plant is way too strong, and rates need to remain elevated for longer than we believe, right? So the final link is this idea of 100 basis points, 150 basis points of cuts between now and the end of next year. It's very hard to forecast rate decisions, but we have a view that rates will remain elevated and painful until we see that adjustment in the labor market and in consumer demand. And really, we just have not seen that yet at all.
I think, you know, one of the interesting things that's sort of happening is that, you know, the US government is facing refunding challenges. And, you know, one of the points that was made last week, I think it was Ken Griffin at Citadel, pointed out that, you know, when they had the opportunity to refund you know, some of their 30-year debt, you know, the long-term bonds, they didn't. And I mean, it probably was, you know, a factor of cross timing, you know, being at odds with QE and QT and a bunch of other things at that, you know, in that moment where they were being criticized also for taking too long to react to inflation. But now they have no choice but to refund 30-year bonds at, you know, 4.6, 4.7, or, you know, even as high as 5% recently. But when you look at that and you see the challenges that are coming, that are up and coming, as well as, you know, the fiscal challenges, then, you know, credit refunding as well for companies that have debt that's rolling over. It's all going to be harder. And so some of those factors, I don't know if I would get into deglobalization so much, but with China not buying U.S. treasuries lately, that's also put a lot of pressure on the U.S. Treasury, on the U.S. government. Do you see what's the probability? I mean, I think what you just said was that it will take longer for the Fed to start cutting. Pausing, yes, maybe, but cutting is a whole other reaction function, right? I mean, something has to go terribly wrong in the U.S. economy or start to look like it's going to go terribly wrong. We've already had sort of a flash earlier this year with the regional banks, going under. And that's another question: is how long can the Fed, or how much willingness is there at the Treasury? Probably it's indefinite, but the Treasury and the Fed have to continue to support the regional banking sector as well as the money center banks that are holding all these held to maturity assets that are under pressure as well in terms of their books, right? So if you look at all those factors, those are where maybe there's a higher for longer or high for longer consideration that I'm assuming you're on that.
Well, yeah,
you're preparing for the possibility that is what the outcome could be over the next couple of years.
Yeah, so I think
even while you're bullish.
Yes, yeah. So, and again, right now, like in terms of being bullish or bearish, we're sort of fairly neutral in terms of beta. So it's balanced across the funds, but certainly some areas of opportunity and defensiveness. But Pierre, to that specific question, more rate hikes, pauses, or rate cuts. I think there's a couple ways to get at that. So the first thing we should remember is the Bank of Canada.
The economy is sorry, Ilan, the economy is resilient. That's the other problem.
Resilient. Exactly.
Yeah.
Exactly. I mean, so and what demand is too strong, right? Let's to put it in one sentence. Demand is excessively strong for the available supply that the economy can produce, and that has resulted in a sizable amount of inflation and a price level that has jumped again, a really big increase in the price level, with a hope that inflation will slow. Again, nothing's going for sale. But in terms of the rate discussion, I mean, this question comes up a lot. Rate hikes, more rate hikes, rate cuts versus a pause. And I think there's two important things to mention there. The first is, and I worked at the bank for 8 years, and David Tulk and David Wolf, my colleagues, worked in that institution as well. They are laser focused on achieving their inflation mandate. Before COVID, we had this saying, don't fight the Fed. We should think about the same thing right now, right?
Right.
They are laser focused on achieving 1 to 3% inflation in Canada, 2% in the US, because the already lost credibility needs to be regained. And in their view, the damaging effects of slightly higher inflation for a little bit longer are more painful than achieving the 2%. Now, there will be a trade-off there, but this idea that 3 is the new 2, I would throw all the cold water on. 2 is the new 2. And
that's their mandate. Yeah,
exactly. And so, and the framework that I sort of use to explain when rates will be cut or where rates are heading from here is this idea of indecision versus decision. And I don't pronounce decision that way all the time, but it's kind of for effect. But, so the way I think about it, Pierre, is so post-COVID, rates were here and we knew rates needed to be here, right? And there was indecision because we don't want to squash the recovery. Oh, inflation is too elevated. Let's raise rates by 475 basis points, right? In larger jumps than we're used to, right? So that is that indecision versus decision. Think about the same sort of framework today. Indecision means rates are here and let's say 5 and neutral is in the 2s. We know eventually we need to be down there, but we're not going to even slightly hint at cutting or normalizing rates until we are absolutely wholly convinced that elevated inflation, call it 4, is heading back down to 2. And that's not
Right.
1 month of CPI prints. That's not 2, right? That's 4, 5, 6, 7 months of consecutive monthly prints that appear as though 12 months from then, they'll be at 2%. Now, what central banks are very good at, and I'm reminded of a conversation that I had at a Brookings conference, I think it was in 2018, where the president of the Cleveland Fed said, in modern central banking, it matters more what central banks say than what they do. So we know on Fed Day, on BOC Day, we've been basically taken on a leash to what they're going to decide to do. But
Right.
it's the communication in between those meetings that conditions where the expectations go, right? And so if we see 4, 5, 6, 7 months of consecutive positive news on inflation, then you will see a change to the language. And you've sort of seen this with Chair Powell, right? You've seen him say, I'm paraphrasing here, encouraging signs on inflation come up, but we must
Right.
remain vigilant, right? So they sort of keep the must remain vigilant because that's that insurance policy. And eventually the must remain vigilant gets dropped and, they're more convinced that the path of inflation is heading back down to normal. And then the language changes to rates may not need to be as restrictive going forward, something along those lines. And then eventually rates get cut. But again, indecision is more powerful than decision. And in our view, rates are going to remain elevated until that adjustment is convincingly begun and on its way back down to 2. And that may require some pain. And again, that word pain is not my words, Pierre. That's Chair Powell's, right? So
That's right.
that's a word. That's a word he has used. I think he used it like 8 times in a 7-minute speech last August. So this is the way that model works. And that's why we think rates will remain at that elevated and restrictive level. That said, the Bank of Canada is very well aware of how sensitive the Canadian household is to elevated rates of debt. They have no desire to implode the Canadian household, right?
Right.
They don't want to overcool the Canadian household, and so I think
hence why they paused sooner.
Well, I mean, exactly. And so again, they have a lot of very smart researchers in that building on Wellington. They know they're looking at the same data that you and I are looking at. They know that these sensitivities exist. And then the last thing to mention is, again, we have a view that rates will remain elevated and probably not push much higher or be cut anytime soon. But how could I be wrong? I think that's important to mention. Just to be honest. So I think I could be wrong on 2 ways on the way down. Right. If the Canadian economy gets T-boned at the intersection in terms of the data, so that's a sharp rise in unemployment, a major deterioration in growth, a sharp rise in insolvencies. Central banks have told us they're data dependent, so they will cut rates and trade off hitting the inflation goal a little bit later for a little bit more inflation now, while to stem the bleeding in the economy. The second way I could be wrong is what we discussed on the U.S. side, right? So if potential growth in the U.S. is higher than what we believe, then rates may not need to be as restrictive as they are, and you get an immaculate decline in inflation. Rates don't need to be in the 5s if neutral is lower than that. But the last thing to mention on how I could be wrong is if inflation gets to, I don't know, low 3s and then moves sideways and is unresponsive to the cumulative tightening that we've had, it does suggest that rates potentially need to push higher. I mean, that's not my base case, but it's not an impossibility either.
That they're pushing on a string at that spot. And
that's it.
In reverse.
Exactly. So, if you can imagine a case in the US where the economy is less interest rate sensitive because of that refinancing and terming out of debt, and inflation just stalls out in the 3s or the mid 3s, that means you may need to do more. Again, it's very hard for me to forecast that far into the future, but it shouldn't be removed off the table. And again, both the Fed and the Bank of Canada have told us that if they need to do more, they will.
that was a very comprehensive response to those three questions.
Okay.
So now that we've covered that, what are the bright spots in the global asset allocation? Like what are the areas where you see the most potential given the scenario that we've just talked about, and how can investors feel assured that not only are you doing the obvious, which is seeking return for their portfolios, but ensuring also that the interest rate sensitivity that we've talked about and the leading and variable lags that are up and coming, the potential for the tightening to actually have a more dire impact on the market, on credit and lending and the consumer. How are you positioned globally and locally in order to overcome those challenges, the uncertainty that poses?
Yeah. So again, if I think of our flagship managed portfolios, the way that we build in resilience is in two ways. We talked about the diversification element, right, across managers and asset classes and currencies, et cetera. But the other way that these are exceptionally resilient is in their tactical abilities, right? And so, put it another way, your grandfather's 60-40 is no longer the 60-40 that we should be talking about. So, the 60-40 that we have, not only is it diversified across managers and styles and currencies, but it's tactical as well. So that 60-40, the global balanced fund, can be a 75-25 or a 45-55, depending on how we want to lean in, right? Optimism, or lean out, defensiveness of various regions or asset classes. And so right now, we've talked about the underweight to Canada because of those concerns and the slight overweight to the US. We have small overweights to Europe and emerging markets as well. Now, there's small overweights. Valuations are attractive. Now, again, I can see the audience doing a collective eye roll. I mean, valuations are not not at all a timing tool, but they're one of the inputs into our 4-pillar investment process. And another pillar of our investment process is sentiment, right? And so sentiment for us is a contrarian indicator. When sentiment is exceptionally negative, that's probably the time for us to be leaning in. And when it's exuberant, that's probably the time for us to be pumping the brakes. So when I think about emerging markets, cyclically, the news in China is not good, is quite negative. But in our view, and again, we work with researchers who help us think about this, is it getting materially worse from here? If the answer is the worst is likely behind us, or we're in the worst of it now, we have to think about what that sentiment and what that contrarian sentiment view might mean. The other thing is, we manage these portfolios for the medium to long-term investor, right? And when I sat in Boston, I sat next to a woman on the asset allocation research team, wonderful colleague, who was the secular analyst for the asset allocation research team. So her only job was thinking about the investable universe at the 20 to 50 year horizon. Really cool job.
Wow. And
every year when she did this capital market assumption exercise, there was no group of countries where the growth outlook and the earnings outlook was more positive than emerging markets, right? So better demographics, they're generally younger, and really that potential for productivity leapfrogs. So if you have, no formal banking sector, you don't build brick and mortar and then go to fintech, you kind of do the leapfrog. That could be a very, very powerful source of growth when combined with younger demographics. So we have slight overweights to emerging markets. For commodity producers, that's an overweight on the equity side as well. That's really motivated in that inflation discussion that we just had. And then on the bond side of the portfolio, we have had underweights to investment grade, both globally and in Canada for some time. They're smaller than they were in the past. A lot of value has returned, but we've chosen really to enhance the income side of the portfolio in the credit and the spread sectors, right? So that's leverage loans, that's high yield, that's global high yield, that's floating rates. That's those sectors where we really have been able to enhance the income side.
Right.
Also on the fixed income side, still a slight overweight to tips, to inflation protected debt, a slight overweight to cash. And then the last thing to talk about on how we're building resilience into these portfolios is our view on the Canadian dollar, right? And so again, I think you asked me for optimism, but this might not quite get there. But I mean, the way we think about using the Canadian dollar in our funds is we use it as a shock absorber, right? So we use it as a risk mitigation tool. So for example, in our 60-40, the underweight to the Canadian dollar right now is, in the order of 12 or 13%. There's a meaningful underweight. And the way that I think about the Canadian dollar is it's a cyclical currency, right? So when equities and credit come under pressure, so think the last 5 months of last year, right? Canadian dollar went from 82 cents to 72 cents. If we're underweight the Canadian dollar, we're preserving basis points in our performance and putting in a shock absorber into our funds. And so that's how we think about the Canadian dollar. It's a very important lever for us to use in terms of managing the overall risk and that end ride for the end investor.
I think the really important question right now with regards to markets is, what's your overarching view on fixed income right now? I know. I think, and I wanted to point out that, you've stressed that you have an overweight on cash, but a couple of years ago that might have been a questionable choice. People would have might look at that and say, "Why do you have so much cash? Are you defensive?" But today, it's actually a sound strategic choice because you're getting the yield.
Yeah,
that wasn't there just a couple of years ago. So suddenly, cash is a great waiting spot. While it's a great place to get yield, especially if you're, right there at the front end of the yield curve. That's a very nice spot right now, right?
Absolutely.
It's not.
Yeah.
So it's a strategic choice. It's a tactical choice as well, right?
Yeah, absolutely. I mean, and this was our approach last year, right? So our approach last year was to have 8-9% of the fund in cash, because we had a high conviction view on what the front end of the curve would do, right? Move much higher, much sooner, and much higher, and less conviction in further out the curve, right? And so again, I mean, a tremendous amount of value has returned to bonds, and for us, really. And if I evolve the positioning to where we are sitting today, those underweights to investment grade have been pulled in. But we need to have more certainty, for example, on the resting spot for monetary policy before we get outright constructive, I would say, on that investment grade position in our funds. And that has been the right call. That has been the right move so far. But again, not to take it back to research, I think every answer I've given you has used the word research, but there is nowhere. I mean, there are a few spots in our process where research really shines. The researchers and that we have access to, and the underlying managers that we speak to on those credit and spread sectors are really best in class, right? And so they have been very, very helpful in terms of enhancing that income side of the fund. But eventually, eventually you would expect that pivot to happen. But again, right now, beta and duration, we're sitting very, very neutral on both of those, with offsets amongst the asset classes. But Pierre, specifically to your point, I mean, this is a question that I get. I don't know. I've done hundreds of presentations this year, and I think I have something like 45 road trips. But that question of GIC versus balanced fund, which I think you sort of alluded to, this is a question that honestly I've just started answering first before the Q&A even begins, because outside of the Canadian dollar, it has become what I call my greatest hit. And ultimately, I think the question really is about time horizon, right? So it's a time horizon question. We haven't had GIC rates like we've had now in decades, right? And you can understand for the downside protected investor not wanting, really would, preferring the certainty of this much upside versus the downside of that much. You can understand that parking spot of GICs. It's very logical.
Yeah, absolutely. I think that's the point is that, like investors have more options than ever right now.
Mm-hmm.
I mean, they have the option of getting the simplest yield on short-term or ultra short-term investments, somewhere between 3.5% and 5%. And then they have similar choices going out 5, 10, 20, years out on the curve, similar yields. Yeah. But obviously the dynamics change as you get into the duration, into longer duration assets. I'm curious to know, and then I have just a couple of final questions. I'm curious to know what your view is right now at this point. Is it too soon, or is the time right for long-term treasuries? Because there's been a lot of barbelling going on, like where there's a lot of money going into, I know these are just like, these are things that are probably happening within your strategy, questions that you're trying to answer within your own strategy, but investors seem to be doing this barbell where they've got lots of money flowing into short term for obvious reasons, but then there's also been a ton of money flowing into something like TLT, right? Which has been gangbusters this year, even though it has up until a couple of weeks ago, 3-4 weeks ago, yields peaked and the value of long-term treasuries bottomed, a near-term bottom, but investors don't seem to be relenting on that bet. So I'm just wondering, where are you in your strategy on long-term yields as far as exploiting not only the yield but the outlook that rates will fall? I'm guessing you're not there yet.
No, we're not. Yeah, no. So we're not there yet.
Yeah,
I mean, to make a long answer short, yeah, we're not there yet.
No.
I mean,
yeah,
we're not there yet. We're probably more there than we were a year ago, but we're not there yet. And that's because anytime I'm asked a question about fixed income, where are we on the curve, I always think in terms. I think I break every one of those questions down into, what is a likely path of inflation, right? That's the ultimate question, because that informs the Fed decision and then informs the entire curve. I pay very close attention to the inflation data. Every month, for example, under the PCE deflator, in the US, we get 356 lines of data. I still run the models I used to run as a researcher. There is not convincing evidence that we have seen enough slowing in order for the Fed to really change course materially. Now, there has been progress. I don't want to say there hasn't been progress. There has been progress, but there has not been enough progress for us to really change that view of underweight investment grade and overweight those credit and spread sectors with a slice of inflation protection built in as well. But that's kind of where we are and where I envision us to be for some time.
That's an important question. I think investors do want to know whether or not they should place their bets on long-term treasuries or not. And the answer to that is, in your opinion, is too soon, way too soon.
Yeah, and I would I would say these are tactical portfolios, right? So we're working with our researchers. We're speaking to the underlying bond managers as well that we work with in Merrimack, New Hampshire. That's all part of the process, and eventually this view, if based on research, will change, and we will evolve these portfolios, right? So right now we're sitting fairly neutral, sitting on that 60 and 40. If I rewind a year and a half, it was almost a 70-30, right? So in the recovery, so we can be quite tactical in these funds.
So two final questions. First of all, what's the dumbest thing you've heard recently or been hearing recently?
So I really think this is a tricky one. That's a great question. So I really think there is there is a view that's pervasive in Canada that housing activity can never fall, that the bank will cut rates so that my debt load will not be as painful as it is today, and that things will be okay. Now, again, like, I like a warm pair of fuzzy slippers as much as the next person, but there are times when, that just isn't the right approach. I'm not sure if that's the right metaphor, but that's the one I came up with. So
It's a good one. I like it.
So, again, like, I think people underestimate the conviction that central banks have in achieving their inflation mandate. They have learned the lessons from the 80s, right, of cutting too soon with that resurgence we saw in U.S. inflation. They're laser focused on this inflation mandate. It's an awful job, I'm sure, right now to be the governor of a central bank. But and if there is pain, that will be viewed in some respects, provided it's not widespread and too significant, as progress, right? And so, again, I've spoken to thousands of advisors, and sometimes what bubbles up is the housing market's going to be fine. Those 8 rental condos that I bought in Vaughan they're negative yielding now, but eventually they'll be back to a better investment. And again, like, I just don't know how Canada in particular doesn't struggle in the face of these exceptionally elevated rates versus recent history, on top of excessive amounts of debt. So I'm not sure if that's the dumbest thing I've heard recently. I mean, another way for me to think about that question, Pierre, I've been at Fidelity now 10 years, and I started at the central bank over 22 years ago. My 2 takeaways are: save more than you think you should, and always be diversified. Right. So I joke that the ABCs are always be diversified, but that's not quite ABC. So, but those are my biggest takeaways, and maybe some people don't believe that.
No, that's a good. I thank you. Thank you for sharing that. My last question is: what's the smartest thing you've heard or come across lately?
I think, again, one of the best things about my job is working around exceptionally smart and talented people, both in Canada, overseas, and in the US. And the research teams that underpin what we do and that inform the positions that we're taking in our funds are staffed by exceptionally talented and bright people that are helping us think not just about not the newspaper level AI robotics stuff, but really company by company implementation, thinking about what it may mean for the future of our industry and the future of various industries. What are the asset classes that are going to benefit? Which are the ones that are going to hurt? Similarly, like geopolitics, which we didn't touch on today. I mean, that comes up a lot as well. Yeah. And it's one thing to talk about or investigate or think about geopolitics from the newspaper style level, but it's another thing to work with, a researcher on that asset allocation research team who spent a career at the CIA and is now helping us think about geopolitical risks and what it means in the context of the investable universe, right? So, again, I'm a recovering research nerd. I'll always be a research nerd. There's no substitute for high quality research in terms of our investment process.
Amazing. Ilan, thank you so much for your incredibly valuable time. It's been a huge pleasure and an honor to speak with you today.
Thanks, Pierre. I've really enjoyed this discussion as well.